Yo, what up, though? This your boy Blade, reporting live from Tampa, Florida. I'm from Detroit, though. I rep the Lions for real, but this season, about to see what's to the Buccaneers since I'm here, anyways. But anyways, I know a lot of times I just post content. I never gave a real introduction, like who I am, what's my background, where I come from. So I'm gonna do that today. So just to give y'all some qualifications, so y'all know who I am, where I come from. I graduated from Michigan State University with a bachelor's degree in biomedical laboratory science. So yes, I am a scientist. I've done work in a medical laboratory at hospitals and things of that nature. Um, Also, I am pursuing an MBA in finance now. I should be done within the next 4 months. Time is flying by. Almost done my finance degree, which is crazy. I have a science degree. Then I'm getting a finance degree, an MBA, a master's. Your boy educated. You hear me? In addition to that, a couple years ago, I got my Series 65 license. So I am setting up my own financial advising firm. I have experience managing other people's money, and I'm taking it to a professional level. The roadblock I'm facing right now is Florida regulators. They take all day to approve your firm. I did all the compliance. I did that in-house. So I'm not to do compliance now, which is crazy. And yeah, I'm just sitting back waiting. And shoot, once I get done with that, and once they approve my firm, all I'm doing is investing people money for them. So until that happens, I'm gonna be uploading content every single day. I want my content to start focus more so on education versus just stock callouts, because I know everybody on YouTube right now is doing stock callout, hot stock picks, things of that nature. Right now it's like an AI buzz going on. All that is a bubble. We'll get into that later. But I want my content to focus more so on education, right? And when I say education, I don't mean just the surface level stuff like what is a stock, how to get started, click on this link so I can make money. Nah, ain't none of that. I'm talking some real stuff that you have to sit down with an actual advisor and pay them $300-400 an hour just to talk to them about your personal finances, right? And I'm gonna say this once, and it's over all my videos. None of the advice I give is not financial advice. Now, for something to be considered financial advice, you have to be personal to your situation. So let's say, for example, if someone go in the comments and they ask a question about their financial situation, and I give them information based on that pertinent to their financial situation, that'd be considered financial advice. So I am a financial advisor, but I'm not your financial advisor. We have to sit down one-on-one for that to happen. So anytime I post videos or content regarding finances and education, that is not financial advice. You can't call that financial advice. So the information that I put out there, you have to make your own investment decision. You have to make your own financial decisions. I don't make that for you. Just because I say, hey, I see this stock here, this IPO, that is information I'm providing in general to the public. If I say, hey, this is what someone under the age of 25 should do or invest in, that's still not financial advice because it's not personal, it's general, right? So I just want people to know that. So when I do start, providing education and information, someone will say, hey, he provided me financial advice. No, I didn't. It's not personal to your situation. Anyways, I always start all my videos off with looking at the news, because what really drives the markets for real is headlines, is news. If Trump say, hey, we going to war, market's crashing. You hear me? We going to war with China, Russia, all them, saying this theoretically, market's crashing. If Trump say, hey, no tax for anybody, and I'm giving out $10,000 refund checks to every household individual who pay taxes, markets is shooting up. It's like what happened in the pandemic, right? So things like that is things that drive the market up, right? We call those headlines, events, market news. You also got financial events. You got GDP. You have CPI report. You have housing sales, things of that nature. Those are economic events, as well as earnings that also influence the market if it goes up or down, right? So things like that are things that people need to know before deciding to invest or trade. These are like fundamentals, or like the very basics of investing and trading when you're involved in the markets. Now, if you hire a professional such as myself or another company to manage your your money or portfolio, then you don't have to worry so much because you're delegating that task to them, right? But if you're an individual who is saying, hey, I'm not about to hire some professional guy who got this degree or a shiny license because I could do it myself, then cool. But just know if you're going to do it yourself, that it's basic things you need to know as an individual investor, right? And we call those people retail investors or retail traders. So Bloomberg, I use it. I got a subscription. I'm not logged in right now, but when I wake up in the morning, first thing I do, I check headlines, see what's going on, see if anything that's going to impact the markets like this one. Trump hits India with 25% tariffs, threatening more over Russia. So something like that won't have a huge impact on the markets. And this was reported pre-market data. So all that is already priced in, right? Terror at Blackstone. See, yeah, devastating. RIP to people who, lost their lives. But that don't affect markets. Anything else? Nope. Don't see anything. But something that is going down today, 2:30 p.m. Jackson Hole. Your boy Jerome Powell. You know who Jerome Powell is? He's the head of the Federal Reserve Free Open Market Committee. Today is Fed rate decision day. This is the day where they announce to the public if they're going to cut interest rates, keep them the same, or rise interest rates. Based on all the news reports that I read, the Feds are going to keep interest rates unchanged. Now, that information could change today. They could decide, you know what, we'll go cut interest rates. If that happens, if you're in call options, you're going to lose some premium value, right? If you are going long or investing in stocks, your stocks may rally today. You know what I'm saying? Well, it's less likely to happen for them to increase interest rates because the president already said, like, hey, it's time to cut rates. Everything's expensive. People don't want to buy homes anymore because it's high interest rates. And now Jerome Powell is receiving pressure from the president, And it's kind of weird because monetary policy and fiscal policy are supposed to be two separate entities. And you have the president who's kind of like pushing and influence. Supposed to be two separate entities, but it seems like it's kind of combined into one. So that's it with the news. And we're not even going to talk about stocks right now. We go focus more so on the fundamentals of investing and trading. As I said earlier before, sometimes people, hold on, I got to pause. I'm back. My bad, y'all. I had to go get my eggs off the stove. Listen, these eggs, I'm telling you, best thing you eat. Hey, you bitches bust. Quick, easy, straight to the point, save you time. Cool thing I hate taking a whole hour to cook. That's too much. Boiled eggs ready in about 20-30 minutes. While I'm working, eggs cooking. They done, come back, boom. Anyways, let's get back into it. As a professional, the first thing we do when we, get a new client, we do something called client profile. Something I notice when people decide to invest in their own, they don't do their own client profile. And what is a client profile? A client profile is the basic information you need to know about your customer: age, marital status, income, sources of income, net worth, debt obligations, and things of that nature. If you don't know those basic things, you have no business investing, let alone dealing with money. Another thing, part of that client profile, or we should say self-profile, is knowing what tax bracket you in. Risk tolerance. That's really important. Some people jump right into investing without even defining their risk tolerance. Like, can you afford to lose 50% of your portfolio, or are you willing to lose only 5%? If you don't know that, you should not be dealing with any money in any sort of investments. You have to define your own personal risk tolerance. My risk tolerance is different from other person's risk tolerance. That's not something someone can define for you or you can copy. You have to define it for yourself. Like, my risk tolerance, since I'm still young, I'm 28 years old, I have a higher risk tolerance than someone who's about 50 or 40 years old, And we'll get a little bit more into risk tolerance a little later. That's highly important, especially when it comes to selecting the right investment for you. A lot of people who, they think, oh, I want to start investing. The first thing they go to is stocks. Stocks is not the only investment vehicles. I know other people may know of, business entities like LLCs, S corps, partnerships, things of that nature. You have a wide variety of investment classes. You have bonds, you have futures, you have option contracts, you have they call it hard assets like real estate or precious metals. So things like that are important to know when it comes to investing. Also, when it comes to considering your risk tolerance, because if you are conservative, that means that you're not willing to lose a huge chunk of your portfolio in a given day or year. So stocks will be the best asset for you, as well as option trading. Option trading is extremely risky. Something like that, they call those derivatives. So options, futures, those are highly risky. Crypto is highly risky. Those are things you should be wary of if you have a low risk tolerance. Now, if you have a high risk tolerance, then the stock market, mutual funds is a good choice for you. But that all comes back down to defining your own client profile. Where do you stand financially? What tax bracket are you in? What are your sources of income? What can you afford to lose? If you can afford to lose $100, then you may have a more moderate risk tolerance than someone who's not willing to lose $100 or can afford to do it. And it really comes down to what can you afford to lose as well. Now you may be like, okay, if my rent is $1,000 a month, don't. Look, we work on that, y'all. We are working on it. I'm trying to get like a nice setup going here, so it's not just a blank bare wall, but AC's that way, vent blowing in, wind coming, it's knocking this down. Maybe I should know it. Command strips. I should get command strips. But back into it. The safest investment vehicle you can get into is U.S. Treasury bonds, bills, or notes, bank CDs. They don't pay as much as interest, but they are the safest compared to stocks, options, or crypto. If you're super conservative, you're really income driven. Usually people who are older, 50 to 60 years old, they're looking more to invest into bank CDs, money market accounts, treasury bonds versus being in the stock market. You in the stock market, you are highly exposed to one of the highest risks out there. You have to be very careful when it comes to that. You have to define what is your time horizon. Are you looking to make a return within the next 2 days, 2 weeks, 2 months, 2 years, 20 years, 10 years? That has to be defined. Because let's say you decide to invest into a treasury bond that expires 10 years from now, and your time horizon is about 60 days, that doesn't match up, right? So you just made the wrong investment decision for yourself. And that's a lot of things that people don't think about when they go into start investing. Oh, I heard this guy on YouTube start talking about bonds, so I'm gonna go invest in the bond, not knowing what they're doing. And they invest into a 30-year treasury bond, right? That doesn't make sense. Also, another thing to consider when investing to different asset classes, some asset classes such as bonds, they have certain ratings. For example, Argentina issuing a bond, they have a rating, let's say they have a C rating. You probably don't want to invest into that because 9 times out of 10, you won't get your money out. You won't get your money back. That is highly risky. Then you have like triple A bonds rating, things of that nature, which is U.S. Treasury notes, bills, or bonds. Those are more secure. And you have certain risk factors that's outside of your control. A meteor hit then half the United States. Treasury bills are going to crash right to the ground. Okay, half the United States just got hit with a meteor. So of course, it's things like that's outside your control. They call that geological risk. If you're managing your own portfolio, you should at least know 90% of the risk. Here's the next segment that I want to get into. And it's the most important. Portfolio management styles, techniques, and strategies. What is that? That is the most important part when it comes to investing in anything. Whether you invest in the stocks, bonds, ETFs, or crypto, that is something you have to have part of your strategy or some sort of plan, right? You don't want to just say like, oh, I'm just going to buy this because I heard it was on Reddit. You're going to lose half of your wealth. For example, in 2020, the markets went down over 20%. It was a lot of investors who was in it for the long term who sold off pretty early because they didn't have a plan, right? They didn't have a plan. They didn't know what they was doing. They just bought into random things, trying to just get into investing anytime, but they didn't diversify. What does that actually mean? Does that mean just invest in different types of stocks. Like, okay, okay, I'm going to invest into Google. I'm going to invest into Apple. Okay, those are tech stock. Let me go to invest into waste management or something in industrials. Is that diversification? Yes, that's a diversified stock portfolio. However, you have to diversify in different aspects. Spend all in into stocks is not the best idea, especially when you have a lot of wealth. To drive wealth, people do use stocks to increase it. But you also have people who are conservative who don't even touch the stock market and they just stick to money market accounts, bonds, and bank CDs. Those are less risky. Certain ways to go about creating that type of portfolio. There's something called a bond ladder. You have efficient market theory, tactical asset allocation, strategic asset allocation, and one of the most popular ones that people use all the time that's on a bunch of YouTube videos is dollar cost averaging. And there's a bunch of theories and it's just this one. Hey, you know what? This is what I'm gonna do. I promise by the next video I'm going to go buy some Cremant strips because this can't keep happening. Now let's talk about the strategy part. I'm the type of investor, I enjoy buying 100 shares of a stock at a time. I think piecing off into stocks, it will take a really long time to build wealth. To really invest in something, buying 100 shares, like a whole lot, makes the most sense, right? Otherwise, you'll be spending years and years trying to buy, one share of Facebook, which is $700. So you don't always have to go for the most expensive tech stock, right? Yes, it will grow. Yes, you'll get maybe 20-30% in a year, but you have a higher yield for return when you invest into growth companies, right? Or companies that are undervalued. And that's part of investing strategy. But let's say, for example, I buy 100 shares, market go down 20%. How do I protect myself against that? That's where it's called hedging. Hedging with equity options. A lot of people use options to trade with to make income. Investors use option to hedge against their portfolio. If you have 100 shares of, Pinterest, for example, today's federal rate decision day, and you feel like, okay, the market's going to be down for the next couple of weeks, or today's going to shoot down a lot. Friday is coming up. Put option, selling the call option. If you have 100 shares of that stock, it would hedge against that. So as the stock go down, you make money as the stock go down, to put it simple. So hedging is important. Some people use bonds to hedge because when the markets go down, the markets crash, the price of bonds go up. So bonds can be used as a hedging strategy as well. That's all I have for the portfolio management styles and techniques. I think what I'm going to do a video on each topic to kind of break it down so it make more sense for everybody. But I do want to end off this section with just stay in the 4 different types of asset classes. You have cash of equivalent, so which are bank CDs, your checkings account, money market account. You have fixed income investments, so personal bonds, U.S. Treasury bonds. You do international bonds. Then you have equities. So another word for stocks is equities. Then you have hard assets like real estate, collectibles, Pokemon cards. You have like that $1,000 Charizard card, precious metals, and things of that nature. So those are the 4 different asset classes. So when someone said, hey, it's good to diversify, it's not just mean diversify different types of stocks. It also means to diversify different types of asset classes. So if the markets do go down, you still have then you also have precious metal that still may be stable, that still may go up. Or you may have this collectible card where, it still holds its value. So you're not putting all your eggs in one basket. But something that's not the best idea to do is to go all into stocks or all into bonds and just having all your wealth into one asset classes. Even Warren Buffett himself have different asset classes. He stayed far away from real estate for some odd reason, but he have stocks, he have bonds, he have big CDs, he have money market accounts. He have different types of assets where his portfolio is diversified. And the craziest thing about it, his cash on hand is over $100 billion. Just imagine that. Your liquid assets is $100 billion. Can you imagine that? That is the craziest thing I ever heard. But anyways, that is important to note because a lot of people, when they start developing wealth, they'll put 90 to 95% of the wealth into investments. And they often have to liquidate their investments to pay day-to-day expenses like bills, buy equipment. That's if you have your own business. That's not the best idea to do. You should have some sort of percentage of your wealth liquid into easy to liquidate assets if you still want to invest, make interest off your money. So it's not just sitting in your checkings account. And that's why you have a money market account. You have bank CDs. Those are highly liquid. They don't have a long expiration date like a bond or like a 10-year treasury bond. You can always have access to your money. But something that's not a good idea to do is to continuously liquidate your investment, your long-term investments, to pay day-to-day expenses or every other month because money is short. I know a lot of times people talk about bonds and things like that, and you're like, okay, how do I buy bonds? I go directly to the source, treasurydirect.gov. I have an account here. I'm not going to log in because it's going to show all my personal information. But you can buy bonds, you can buy bills, you can buy notes. It's sold directly by the U.S. government. This is where you go to buy your bonds and notes. Then they have different ones. And all the information you need to know about them is on here. And you can always, do your own research. I hate saying do your own research because I'm providing you with the information. I'm doing the research for you, right? But here's where you go to do your own research. I should say do further research. Further research is better because I present the information to you. You have the terms. Now all you have to do is just go look it up. Then you have the PSEO bonds. These are bonds that are issued by local entities such as airports, colleges, schools. Let's say, for example, the Buccaneers want to build a brand new training facility for their players. They'll issue a bond and say, hey, investor, we'll give us $1,000 and the next 2-3 years we'll return your money back. Or let's say they want to build a brand new stadium. That would make more sense. You want to build a brand new stadium. It's going to cost them $10 million. Out of that $10 million, through ticket sales and events, they're going to make about, $100 million over the course of the next 10 years. So they issue you a 10 or 15 year bond where they say, hey, you invest $15,000 today, $20,000 today, we'll give you 2% interest or 2% yield over the next 15 years. Each year you hold on to this bond. Then when it matures, then we'll give you your money back. And that's how the PSEO bonds usually work. And since I live in the state of Florida, I'm looking at Florida bonds. Let's see, Tampa, I don't know what it is, wastewater sewer system, whatever. So there's a bunch of PSEO bonds that's available. Oh, I forgot to touch on this. This is called the investment pyramid. So as you go up, the risks increase. As you go down, it's less risky. So at the bottom, you have treasury securities. You have, I'm not going to talk too much about life insurance. It could be a whole nother life insurance video. I forgot to mention, I am a licensed insurance agent. I don't know. I always forget about that. I am a licensed insurance agent. I have that. I did that back about a couple years ago. I have so many licenses, degrees, and stuff at this point. I typically forget. High grade PSEO bonds. You have mutual funds. You have common stocks. So you see, as you go up, common stocks is up there in a higher risk area than treasury securities. Then you got limited partnerships. So let's say if you start, your own business with a partner and put said amount of money in, call and put options is on the same level as that. So call and put options are highly risky. Don't forget that. One moment could be up, the next second, literally very second, it could be down. You have speculative common stocks and bonds. So let's say all these new AI companies popping up, right? It's all speculation. Like, it's a company that IPO today is called Embic, right? That's all speculative. Anybody who invested today is all speculative. They just went public. It's not much information historical information out there about them. So it's like investing in that today without even doing any research is highly risky. It's all speculative. And speaking of speculation, I did want to talk about some speculative stocks. So, for example, super microconductor, right? So right now, as you can see, it's been rallying, gaining about 2 to 3% a day, sometimes 1% a day. It had a pullback yesterday, which is good because I won big on my put option that I got into the day before, and I made some money. But super microconductor is speculative, right? And what does the speculative mean? That means retail investor or traders or whoever is assuming that this company is going to increase in value without the proper fundamentals to back it. So you call that a speculative stock. It's all speculative. there's nothing fundamental about the company, or there's nothing fundamental that that investors are basing their decision off of to invest into this company, right? And when it comes to my style of investing, I don't rely my analysis based on speculative plays. I look at everything from a fundamental perspective, because day traders or technical traders, they lose the most long term compared to value investors. I would consider myself a value investor. I learned from reading Warren Buffett books and how he invests into companies, and I apply the same thing when it comes to investing long term and trading. And through those methods, I've been able to identify undervalued companies that grew over the last 10 years to multi-billion, almost trillion-dollar companies. One example is AMD. About 9 years ago, AMD was trading about $10 a share. That was one of the stocks I added to my portfolio. I called out AMD, General Electric, which is now General Electric Aerospace. It was trading at $10 a share. So it's like companies like those that was going through financial issues, that hired new CEOs or CFO to turn the company around, and it happened. Actually, let's go to GE right now. GE, is this the same one? I think it's GVA. Nope, this is it. So if we go to, let's go to the 3-year chart. Just look at it. Boom, just growing. You see that? That is amazing. And at some point in time, it was like $38 a share. Now look at it. It's trading at $273 a share without a stock reverse merger. That is phenomenal right there. So if you got in, what year is that? It's look like 2022. So if you got in 2022 at $38 a share, even $40 a share, you're up well over 50%, if I'm doing the math correctly. So General Electric, things of that nature. Another one I always tell people that I believe is the next big social media giant is Pinterest. So right now, Pinterest is trading at $38 a share. I'll call Pinterest out back in 2020. I thought it was 2025, but 2020. I feel like Pinterest, and this is based on the business model of Pinterest and also advertising revenue, that this company is going to be one day worth $100 a share. I feel like right now it's way undervalued. I believe they IPO back in 2020 or somewhere in that area. But the thing with Pinterest is they have a high amount of users who are women, and they shop through Pinterest. They click on the links, they get ideas, they pin things, and like ask any woman in your life, do they use Pinterest? 10 out of 10, they will say yes. Pinterest is like a essential app that most people have on their phone, especially for women. So Pinterest is the one to keep on your watch list for the long term. Add it to your portfolio. I'm working on getting my 100 shares back because I sold it during the pandemic, just trading it. Currently hold about 50 shares of Pinterest, but I'm going to increase my shares of Pinterest. And it's something called odd lot. Odd lot is when you buy anything less than 100 shares, right? So usually retail traders or the inexperienced or less professional investors, they will buy like 50, 20 shares and maybe fractional shares at a time. And there's nothing wrong with that. You always got to start from somewhere. But as you get more experience into the markets, it's make more sense to buy 100 shares at a time, to buy a whole full lot. Oh, I did this play yesterday. I posted a reel on, or a short. It's called SoFi. SoFi, I believe they had earnings the day before or yesterday. And they just skyrocketed out of nowhere. I seen it. Someone called out my group chat. I seen it. And I was like, okay, I'm going to get a put option. So I got a put option yesterday. I made over 50% return. It was crazy. And now it's still going down. Today it had the low of $20.43 a share. It looked like the high was $21.81. I still feel like this got more room for the downside to correct. But right now everything may stagnate out into the Federal Reserve meeting today. So it shouldn't be nothing too crazy going on in the market until, oh, this is a big drop. It went from 25 all the way to $20. Perfect place setup. So yesterday I got in. I think it was around like somewhere around here, probably like 20. It was at 24. It was like 24 something. I pulled out when I made my 50% return. If I would have held on to it, I would have made more money. But my general trading rules, I go for 20% return. Once I make my 20% return and I seize the 20% return, I pull out regardless of what's happening. Sometimes it will ride on accident, but I manually do the trade just in case it do appreciate in value, right? And when I say the trade, most of the time I'm talking about option trading when I do my trades. And break. I call these dirty boiled eggs because I put a bunch of seasoning on them and just have at them. I'm back. Another one of my group chat called out today is called Marvel Technology. Ticker symbol MRVL. Today, out of nowhere, not even provoked by any earnings report, it skyrocketed by, I believe, skyrocketed by 10% today for no provoked reason. I did a little research today, and let's go to the article MVRL. Let's go to news, and it's the first thing I do when I see something skyrocket, sees anything important in headlines. And actually, I can go on here. Look up news. MRV. Right here. Bam. Here we go. Marvel Technology shares are trading higher. Click on it. Now this tells us Marvel Technology shares are trading higher. The company announced a collaboration with Rebellions to offer high-performance, energy-efficient AI systems tailored for regional-driven and sovereign-backed AI initiatives across APAC and the Middle East. Now, what did that sound like to me? Pure speculation. Anything that sounds like pure speculation, the first thing I'm going to do is short. And why would I short? Why would I get a put option or why would I sell a call option? Because nothing fundamentally changed about the company. And when I say fundamentally, I mean financially. You look across their balance sheet, their income statement, their cash flow statement, nothing changed. No ratio change. Only thing that changed was news. And when news moved the market or move a stock, an individual stock, it is usually short-lived. And if it's usually short-lived, that means the price action we see today is not going to be the price action we see within the next couple of weeks, unless something fundamentally supported, right? Now, if the company announced like, hey, we're going to buy back more shares of our own stock, that's a huge change. That's a material change. If they announce that we're going to, let's say they come out with earnings and they say, hey, we increased our earnings by 25% over the last quarter, then heck yeah, it's time to buy some call options on that, even though they're already priced in. But if it's based on news, it's like water weight. You're going to lose it quick. So play like this, I would actually set up a short position. However, I'm going to be real conservative about this. I did my analysis from the 4-hour chart, right? And it's this tool called Fibonacci retracement. When something hit the 61.8% level, usually it reverses in the opposite direction. So I'm waiting for confirmation for the stock price to rally to $97.19, even $95. So I've been waiting since early this morning, and I think the stock lost a lot of steam because it have shown resistance at $84 a share. With that in mind, since there's nothing that fundamentally changed about the company, earnings is not until next month, this is still screaming and telling me that this stock is going to shoot down and correct itself pretty soon. And given the fact that we see like huge rallies, followed by a rally, instantly decline. And we can see that this happen every other month. This is happening, right? Actually, it looks like two or three times a month. It shoots up, it go down. It shoots up, it go down. So this is like a predictable pattern that happens time after time again. So it shot up recently. What's going to happen next? It's going to shoot down, right? So let's do the 1-hour chart. And actually, let's do a Fibonacci retracement on this one. based on what I'm seeing now, we should see a bounce. I believe it's going to self-correct to about $76, and we should see a bounce soon. But let's do the levels from yesterday, lows and highs. So it looks like I already corrected to the 38% level. So if I get in today, let's say I get in today, right? Based on this Fibonacci retracement level, it will correct to about $80.74, possibly $79. Now, if I do a day trade, I could potentially win from $2 or $3 if I get a put option, right? So there's still a chance to make money from this stock. I think it capped out at $85.27 a share. So this could be a good trade setup to go short. You know what? We may just take this play. What time is it? 11:50. I'm gonna wait. I'm gonna wait for it to rise up a little bit. Like, still got some buyers in the market. Let's go to active trader and see who's still doing some buys. This is interesting. Buying pressure have slowed down. It is way overbought according to the RSI indicator. I need to cross the 70 again before I get into position. So probably about 83. I'll short it. That makes sense, yeah. But I bought up the stock because I feel like AI is the bubble that's going to pop soon, right? Every 5 to 10 years, you have some new technology sort of bubble. Dot-com bubble back in the 90s. The real estate bubble back in the early 2000s. You had the crypto bubble in 2017. The metaverse bubble in 2020 to 2021, / NFT bubble. So anytime technology is like driving the markets and people being very speculative, it's time to slow down and think, what's going to happen next? We see this play happen time and time again. I've been in the market the last 10 years, and I see it happen all the time. I read all the history, and there's always some sort of bubble where some new technology or innovation come along. All these companies try to slap the brand across their damn logo, right? And it's short-lived, usually within a year or two, or even less, the bubble pop. People lose a bunch of money. People start to curl up in the corner and think, oh, I hate the stock market. And it happens time and time again. So after this bubble pop, the best thing to do is to DCA, dollar cost average, to the bottom, right? Don't wait for all-time highs. Like, oh, it's a great time to buy. That's how you lose big. It's like buying, let's say, for example, MRVL is at all-time highs at $85.27 a share. And let's say all the investors see, oh, I'm going to buy in. AI is hot. Now, when it corrects, which it's going to do, it's going to correct to about $79. And let's say you buy 100 shares, you lost $300 right off the bat. And let's say long term, the market crash, because at some point in time, the market will crash. It's going to happen. It's like at some point in time, we're all going to get sick. We're all going to catch a common cold. We may get bit by a mosquito. Things happen to our health. Nothing is perfect. And the market works the same way. There are humans participating and things happen to humans. Somebody who have 100,000 shares may need to liquidate to cover some expenses. Who knows? That could drive the stock down. So the market is like a person breathing in and out, right? So at some point in time, it has to go down. Everything do not go up forever, just like how everything do not go down forever. So with that in mind, it's best to be conservative when it comes to these speculative plays. So I make money for both sides of the market. When things go down, when things go up, that's how you win. Cause that's how the market maker set things up. for it to be. So when it comes to the AI, all these companies, be very careful on what you invest into because it says AI. Just because it says AI does not mean that it's gonna go up forever. Now, I will say there are some major companies who are leading in innovation when it comes to artificial intelligence. You have Facebook. Facebook actually just recently stole, they keep stealing employees from Apple to develop their AI department, right? So Facebook is really hot on my watch list right now. I'm going to add more shares to my portfolio of Facebook. Apple is another one. They are trying to develop and innovate AI into their new iPhones and other technologies. And you have Microsoft. We already know that Microsoft, when it comes to technology is on the forefront of everything, right? And I think that is all I have for y'all today. Sam Blade from Detroit, trying to see what's to the Buccaneers this year. I think they're gonna have a good year. I went to their training camp, and players look promising. They about to do something this year. I know for a fact they going to playoffs. God, so they do it every year. Now it comes to the Lions, I ain't gonna hold you. I gotta go with the Lions always. You hear me? But I'm in Tampa, Florida, so gotta see what's to the local team. You hear me? To end it off, I just want to make sure I give y'all some gems. If you haven't already, before you invest, save. Save as much money as possible. Only invest with your discretionary income. What is discretionary income? That is money you have left over after you pay all your essential bills and expenses. So after you pay your rent, after you pay your car note, car insurance, whatever bills you have that's essential for you to live, that's your discretionary income. Before you invest any of that income, save something. I always say save at least half of your discretionary income for at least 6 months before you invest anything. And that's like super conservative right there. You have no business investing in anything if you ain't got nothing saved. Because why are you putting your money at risk if you don't have nothing, no foundation? Your foundation and building wealth is your savings. It's not about how much money you invest. It's about how much money you keep. Because you invest 100% of your discretionary income into the stock market and the market crash, you will lose 50% or more of your income. It happens, I've seen it happen to so many people. So you all got all your assets into, even you got 80% of your wealth into the stock market, you're exposed to high risk. That's highly risky. Now, if you 18 to 25 and that's you, cool. You're young, you have your next 20 to 40 years to make that money back up. If you older than 35, you 45, you 50, and 80 to 90% of your income, 80 to 90% of your net worth is in the market, you are at high risk. It's time to diversify. Stop thinking, everything will blow up from the market, the stock market. Get into real estate if you want to. Get into precious metals. Get into treasury notes, bank CDs, bonds. You know what I'm saying? It don't pay the highest interest, but you are protecting your wealth. We call that wealth conservation. As you get older, wealth conservation is important because to save up $20,000 is highly challenging. To do that in 5 to 10 years versus the 40 years it took to build that. You know what I'm saying? Or $100,000, $200,000, $300,000. It took a lot of years to build that. So don't put all that at risk and jeopardize that by trying to go all into the markets because you're trying to grow it as fast as possible. That's highly risky and you could lose a lot of money. Stay tuned. I try to post content every single day, winning plays, stock call outs, and just stay tuned. Tap in with your boy. I'm dropping some real gems out here. Like, my goal is to make guys as rich as possible. And also to help y'all keep in mind that, ain't shit sweet out here all the time. Like, things happen. I want y'all to know and consider risk more than anything. Think about risk before you think about making gains. The better you can manage risk, the better you can make gains. Period. And that's all. Stay tuned. I'm getting a Discord set up. Follow me on TikTok at the Index.